Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market Site is Maddie Radner, Director on the Nasdaq Market Intelligence Desk, and Kathy Kriskey, Senior Commodities Strategist at Invesco. We're here to discuss why commodities are currently the victim of headlines ping pong. It is great to have the both of you with us, ladies. Welcome to Trade Talks. And Kathy, this is a great day to exemplify why commodities are so predisposed to headlines. And if you're catching us live, on Tuesday, December 3rd, with the news out of South Korea this morning, you can certainly see the reaction to that.
Right, and I love that, because one of the reasons why I say people should want commodities in their portfolio is that Rumsfeld phrase, the unknown unknowns, right? Something that's not even on our whiteboard, and that's what happened today, right? Nobody thought of the news out of South Korea coming saying that imposing martial law, like nobody had it on, as they said, their dance card or whatever, but it affected almost every commodity. So about 33% of copper is stored in South Korea, the copper from the LME. So that right away, copper had a bid, but in the end, because of the concerns over this news, every commodity, I think except for natural gas, traded higher.
Which is so interesting, because when you walked in, my first thought was, this wasn't on my bingo card this week. I mean, there hasn't been the implementation of martial law, I think, in 45 years. It's been, which is different, because as an example, a couple decades back when we had Hurricane Katrina, there was somewhat time to plan. You knew what your hedges might be. Granted, trading was slower back then, but the speed at which multiple markets reacted was probably one of the best lessons in terms of how commodities act.
Exactly, and that's why we were joking about this ping pong of the headlines. We're going back and forth and back and forth. So we have like strong economic growth, right? We see that, and the market's trading up. And then we have the tariffs, the risk of tariffs. We have potential peace in the Middle East, and then we have OPEC Plus, right? Their meeting coming up, and then potentially extending, right? The bringing back those barrels, right? And even in agriculture, we hit an all-time high in coffee just a few days ago, right? Yet we have loads, and that was due to weather in Brazil and causing a real big problem with supply. But yet in the grain side, we have loads of supply because we've had great weather. So again, this ping pong back and forth, and that's what we say as commodity people, we're constantly looking back and forth and having to trade those markets and truly understand how these news items will affect our market minute by minute.
Yeah, and Maddie, what's so interesting is your sandbox is small cap companies, right? Yeah. And they tend to ping pong like that as well, especially a number of them have exposure to commodities, energy companies as an example. So the fluctuations that you see with commodity prices has a small cap impact.
Yeah, when we think about small caps, they're having a hard time with all this ping-ponging back and forth and all the fluctuations within commodities they're vulnerable to. And these changes in prices do have a substantial impact within the small cap space. It's definitely different sectors, and the small caps have rallied more recently off of the election and the new administration, mostly because of its presence with less regulation, and then on top of that, the lower interest rates have boosted the small caps. That said, there's still a bit of uncertainty with the potential adoption of inflationary policies that we're kind of seeing a lot of movement in the commodity space react to these different policies. So, small caps, when we think about it, they are price sensitive. They rely on suppliers to get different goods and products. So when those prices are not guaranteed, they have a hard time negotiating with their suppliers.
Yeah, it's not easy being in a small cap space. I mean, being vulnerable to rising commodity prices, which obviously is going to put a squeeze on your margins.
Oh yeah.
And being in a higher interest rate environment, really, the catalyst for a while was the thought that interest rates were going to come down, and they really haven't as quickly as I think might have been expected.
Yeah, I think the rally was more on the certainty out of the election and outcome. Right. I think in order for the small caps to really see a positive price impact in 2025, we need more rate cuts. A few rate cuts isn't going to solve their problem. 60% of the S&P 600 holds floating rate debt, so they're relying on these rates to really come down to fund their businesses.
Kathy, when you think about it in terms of correlation with fixed income and equities, if you want to have some in your portfolios, how does it interact with other areas of the market?
That's a great question. So we are a diversifier, right? Because we are negatively correlated to fixed income, and we have a very low correlation to equities. So that's why, and a great example is when, usually when we're watching and the stock market is going down, commodities tend to be going up. Because remember, and you said it, Maddie, that keyword inflation, right? So this risk of inflation, you're right, the tariff policy potentially is inflationary, but also the deportations are inflationary. And think about how commodities, right? A lot of the workers, right? These migrant workers, they leave the country, right? So there's inflation. Could be food inflation, could be inflation across the board. And a lot of people think we have beaten inflation and that it's done. And I think, right, again, commodities, I think that as it starts to come up, and you're right, we need the Fed to still lower rates, but if we see some inflationary signals, that might put a pause or even cause them to shift policy to start going with interest rate rises. And so that is a concern, hence commodities, right? Commodities, the most efficient hedge for inflation.
Will it be a straight line up in 2025? I mean, again, you sent this to me in the morning before the news of South Korea coming out. I mean, obviously, one-offs like that are always going to be part of your thesis, but it could change really fast.
Right, and it will not be a straight line up. And that's why I'm concerned, just sector by sector. Energy, we have a lot of production coming on next year, mostly from Brazil and Guyana, but a lot of production in 2025. But then we have this geopolitical risk. If we have this maximum campaign, a maximum pressure campaign against Iran, right, we don't know what prices could go to, right? And then on metals, on industrial metals, the tariffs could initially hurt the metals, right? But longer term, we have the energy transition, we have the AI data centers, we have the Bitcoin mining facilities. Those all need a copper and aluminum and some zinc. So that is very long term. Industrial metals should be just fine. And then on precious metals, I still like the gold story. Remember, gold had a historical high every month, in 2024, starting in March until the election, right? And then, but a lot of people were speculating around the election. So when Trump had a clear win and there was no trouble, the prices came off. But I still believe long-term in gold. We still have the Fed cutting, and we still have central banks de-dollarizing. And just lastly, on the agriculture sector, I am concerned about grains because we've had these record crops. But the softs, that cocoa, coffee, cotton, and sugar, I'm a big believer that they will continue higher.
Well, it doesn't help with consumer inflation either. I mean, these are all staple products, right?
Yeah, and I think when we think about different sectors and companies that will be attractive to investors as we're seeing these fluctuations in commodity prices, I think companies with a strong pricing power and efficient operational path will be better positioned to withstand all these fluctuations. So certain sectors like within the consumer space and the coffee space impacted by the changes that we're seeing in coffee and chocolate, they might have a harder time, especially as we head into the holidays.
Yeah, I mean, well, think about it. If a commodity costs are more expensive for the staples, who do you think is going to pick up that cost?
Yeah.
Right. So, well, you know what? Speaking of volatility in the new administration coming in, and granted the composure of Trump's administration certainly does look and feel different than it did in 2016, there was a couple years where there was no volatility in the market. I mean, the S&P traded in 3 to 5 handle ranges. I mean, it was basically untradeable for the most part. So maybe we won't get that volatility, but it's so hard to tell.
Right, exactly, and that's why we say uncertainty, right? And you said it, Maddie, uncertainty. That's what we have, so much uncertainty. And that's why I think for commodities, we keep telling people like 5% allocation, very small allocation to commodities. They're volatile, but they're for the just in case, because we have so much uncertainty going forward. So that's why we say, we have this, our top product, PDBC. Like, again, Papa Delta Bravo Charlie. My son always tells me use the military letters, but it is, we cover all the different sectors. We have energy and metals and agriculture, and we are also, it's actively managed, right? And it's a smart index. So that's where we say to people, don't go full force into one commodity. Don't chase commodities. Commodities, as I said, are volatile, so just let them come to you. But when they trade down, it makes sense to scale in to cover for those times of uncertainty.
Yeah, I mean, you're also using a smart beta approach as well.
Yes.
Tell us more about that.
Yes, so people hate to hear contango and backwardation, and I won't bore people, but again, the quick way to remember it is you want to get a B in school rather than a C, so backwardation's way better than contango, right? So, but a lot of investors never know if a market's in contango or backwardation. So we say we have an algorithm, right, that looks at the commodity curves and says, where's the best place to be along this curve? And then just as a secondary, we have actively managed, our portfolio managers are commodity experts, and they are there to watch the markets and to make sure that this product is in the best possible place along the curve and with relative value trades too.
Plus, I have you on the team.
Yeah, that's very fun.
There you go. Yeah, it's just so fascinating. It almost has to be an active strategy.
Yes.
Yeah, I can't imagine going passive, particularly on the news cycle. You had mentioned Brazil, Guyana. Any other areas regionally that we should be aware of?
So it's so interesting because the U.S., a lot of people are like, oh, we're going to drill, baby, drill. And I was like, we've already done that, right? So we are at about 13.2 million barrels per day in the U.S. And just to put that in context, both Saudi and Russia are around 9.5, right? So we are the biggest producer. But remember, shale has a really steep decline curve. So we don't know, how long this will last. So I think that the idea of having our shale producers produce more and push them to produce more, like I feel like they're already at sort of max capacity. So I am concerned about that because one of the policies is to increase crude oil by 3 million barrels per day. And like I said, we're already at 13.2. So to go to over 16, like it's never happened. We're at the highest level historically, but that could really harm a lot of the U.S. producers. So I think globally it should be okay.
Small caps.
Yes, the small caps.
Yeah. Might be an elementary question. The components that go into semiconductors, as an example, or to satisfy this demand that we're going to need with all, this AI transition that we're going through, are any of those part of the commodity space?
Just the metals, right? The industrial metals that are used, and actually silver. And we didn't I love gold, but silver has done really, really well this year because it's not just a precious metal. It's also, it acts like an industrial metals because it is in some of those items like solar panels. But I like the industrial metals for that reason, and that's copper, aluminum, zinc. We don't love nickel so much because there's a lot of production coming out of Indonesia, but certainly copper, alloy, and zinc.
Yeah, I mean, when we look at the small caps and the performance of the subsectors this year, companies that have relied on those materials have actually performed the best. So, I mean, the technology companies, small cap tech, but small cap industrials have really outperformed and stayed in line with their large cap counterparts because of the resources that they're probably using and working with.
Which is a great point that you make, and a little bit off topic, but we had a VC panel yesterday, and what they're looking for is not just the plug and play AI traditional tech plays, but they're looking for all those other derivative ones to allocate capital towards. I mean, energy companies, industrial companies, the supply chain, there's an AI component to all of that.
Across the board, from the small caps to the large caps. So that's really the only space where we see the gap between the small caps and large cap performance a little bit smaller than other spaces.
All right, appreciate both of your insights. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.